Hello, everybody. Welcome to Talk About Houses. I'm Todd.
I'm Juana.
Okay, so we're going to go through Bankrate's estimate for what's going to happen in the fall in real estate. This is U.S. national numbers. Bankrate is a mortgage analytics reporting company. They have tools on their sites for people. They track the whole mortgage industry and the real estate market. Okay, so this is Bankrate's 2022 fall housing market predictions. Okay. This is Bankrate's predictions before people get upset and say, why are you saying this stuff? This is Bankrate's data. We're just going to look at it and talk about it. Okay, so first thing we're going to talk about is the rate of homes that are selling. Okay, in July, the annualized rate of home sales dropped below 5 million homes, which represents a decline of over 1 million home sales compared to 2021. I expect both new and existing home sales will probably continue to decelerate through the fall and winter months, with home price appreciation likely in 2022 in the low single digits, likely in the 2 to 3% range. But that's actually low because the beginning of the year projection was like 17%.
Right. So look, at the beginning of the year, things didn't look the way they look today, right? Things have definitely taken a different turn than I think most of us would have liked. And here we are.
Here we are. So the question they ask is, are we headed toward a housing bubble?
So what's required for a housing bubble? I think maybe we should talk about that a little bit.
Okay. We'll talk about that, and then we'll talk about what they think it is.
Okay. So, a bubble implies that housing is overpriced and that it will pop. And what would cause it to pop? Maybe lack of demand. That could be something. Certainly we're seeing increased inventory. Certainly we're seeing higher interest rates. We're seeing less affordability. So those things we are seeing. The thing that I think we need to keep in mind for the long term, because remember, real estate is a long-term game, right?
Right.
The thing to keep in mind for the long term is, yes, we are going to see some price declines, no question. But what's going to happen is when the interest rates start to come down, prices will start to go back up. So that whole affordability thing is going to be kind of this elastic thing going on. And the payments are not going to change substantially. If anything, I think they're going to stay the same or even go up. And I think that'll be interesting to watch. And what I mean by that is that as interest rates go down, home prices go up, so your effective payment remains the same as it is when the house price is lower, but the interest rate is higher.
Okay. My opinion is based on fundamentals.
Okay.
Okay. We did not have ridiculous lending for the last 5 years, meaning people weren't getting 8% loans that adjusted and now are paying 10%, and they're all upside down their house. Most people, what we said, 40-something% of all real estate is owned free and clear. A bunch of your current listings are free and clear.
All of them.
They're all free and clear. All of her current listings are free and clear. You are getting activity. It's not like they're just sitting there not selling. Some are selling.
It is slow.
This isn't March where everything's sold when you put it in the MLS.
And what's super interesting to me, absolutely super interesting, is that the bulk of the activity is from flippers.
There are a lot of flippers.
There are a lot of flippers in the market, and these are the people that they're not flipping one or two homes. These people are purchasing, dozens or maybe even 100 or more homes a year. So this is what they do. So they're good at it. Okay.
Yeah.
And they are almost, I can't think of a single property that I have not gotten at least one flipper offer on, if not multiple offers from flippers. And that's not to say that we sell to the flippers every time, but it's to say that these people see an opportunity. These people do not see the sky falling. They just see the opportunity.
If a flipper, a professional flipper, thought prices were going to drop 20% in a couple months,
they would wait.
Why would they buy a house and try to flip it when it's going to be less? They would lose their shares. So the flippers aren't apparently not seeing. The other fundamental thing is we still have a shortage of overall homes available in the U.S. We're not talking on the market listed, because that number's gone up, but we're still well below the 6-month average. Nationally, we still have less homes nationally for sale than we have historically, like in a normal market.
Right. To put it in perspective, I think the last numbers I saw that we were on par with the summer of 2020. So it's as far as inventory.
Okay, inventory, which was just 2 years ago, and that was interesting market. Okay, this is their opinion. Housing market today is not driven by loose lending standards, subprime mortgages, or homeowners who are highly leveraged. And we know this because we did a video. 90% of all people have at least 20% equity.
Right.
Okay. The house price appreciation in today's housing market is supported by the fundamentals and characterized by shortage of supply relative to demand. That demand has primarily been driven by millennial first-time buyers aging into their prime home buying years rather than fix and flip investors. That's what they're saying that's what drove the market.
Right.
Yeah.
So I want to kind of touch on 2 points that you made.
Okay.
The first one is the amount of equity that people have in their homes. And it's interesting because I got a call from somebody who actually watches our video blog.
That's right.
And he was rather frustrated because sellers were turning down his less than full price offers.
Yeah.
And the word he used was that the sellers were arrogant.
Because the sellers haven't watched the other videos that say the market's already crashed 40%.
Right.
And they have to sell now at 40% off.
Right.
And they don't understand why these people aren't just discounting their house a ton and selling it.
Right. So he felt that the sellers were arrogant. I kind of bristled at that because I think sellers are, as I like to call them, optimistic.
Right. They certainly are. They're still optimistic.
Yes, they're still optimistic. So the reason sellers are what I call optimistic, some of you might say that they're unrealistic, is because, like Todd said, they have a lot of equity in their homes. So they are not distressed. They do not have to sell. Very few people actually have to sell, okay? Maybe they're liquidating an estate and they have to divide up the proceeds, amongst the heirs, or, maybe they're moving across the country and they absolutely need the money to purchase the next house or whatever it is. But very few people are actually in a position where they have to sell. Most people would like to sell, and that's why they're on the market, but they don't have to sell. Okay?
Yeah. I think that's different than 2006, 7, 8.
Right.
There were people that had stopped making their payment because their payment was $2,600 a month. If they decided to rent the house, they could only get $1,200. And they had to sell because they weren't just going to come out of pocket $1,400 a month, and they all gave up.
Right.
That's not happening now. If you have a 2.75% interest rate, even if you're upside down, even if you bought it 6 months ago or whatever, and you're basically at break even, you don't have to sell, because if you sell, you give up that interest rate, you're not going to get it back. And then you have to go rent somewhere, and your rent's going to be more than your interest payment was 6 months ago.
Right. And even if your mortgage payment is about the same as you would get if you were renting, somewhere else, wouldn't you rather keep the house, right? This is the house that obviously you really like, because that's why you bought it. And so there are other reasons involved with that.
Right.
And then to Todd's point, as far as this generation that is coming into their own and they're purchasing homes. Now, I realize that the buyers have kind of maybe taken a step back and they're uneasy about the economy, about energy prices, about interest rates, about a lot of things. And they're going to take a step back, and that's okay. But that's not a forever thing.
Right.
I think come springtime, people are going to become numb to all of this, whatever this is. And they're going to just wake up one day, just like they did with COVID and with everything else, and say, with it, I'm going to live my life. I'm going to go out and buy a house.
The housing crash that started in 2006, when we had 26,000 homes on the market, took 5 years of price declines. 5 years of price declines. So my opinion of people that are selling right now, most people that are selling don't have to. A lot of people have told us they'll sell if they get this price. If not, they don't care. There's some people panic selling because they're afraid. They're certainly doing that.
Yeah.
There are people panic selling now the way there were probably people FOMO buying a year ago, right? They were FOMO buying a year ago. According to Bankrate, this is in their words from the article, there is no housing bubble, based on what they're saying. So you can take it for what it's worth.
Right. So look, we understand that the experts have been wrong time and time again, and we are not saying that this is the absolute truth of anything. We're simply relaying information and giving you our opinion.
And we're not saying, because I get accused in every video, oh, why are you telling people home prices are going to keep going up? We've never said that. All we do is we talk about what's in here, and we've said they could go up, they could go down, nobody knows. So we're talking about the fundamentals. The fundamentals really haven't changed. And what I'm noticing and what I'm seeing is people will take an outlier event and they'll say, oh, well, in this one neighborhood, this house sold for 600 and somebody just sold one for 450. But then they won't, maybe Open Door bought the house for 600 and they overpaid for it. And then the 450 was a distressed sale because the house was trashed or something. So I'm seeing these outlier things. When you look at the total of data, yes, is the market weak? Yeah, because interest rates are going up. There's some more sellers on the market, but what's really interesting is, I'll give you San Diego as an example. The number of solds in the last 30 days was not that much different than the number of new houses on the market, which means the houses are being absorbed as they come on the market in San Diego. Now, this is not, these numbers are national numbers. They're not San Diego. And in some markets, even within a market, there's probably parts of Las Vegas that it's a train wreck. So people that are going to support that opinion will just look at the train wreck areas. There are other parts of Vegas that are they're solid and everything's going relatively good. We're going to talk about who bought houses in 2021. This is based on last year. We're going to talk about last year's data, okay? So we're going to put up this chart here. It breaks it down by the generations, 21 and younger Gen Z, younger Gen Y and millennials, 22 to 30. Older Gen Y, millennials, 31 to 40, Gen X, 41 to 55, boomers, 56 to 65, older boomers, and then the silent generation. And you're seeing this interesting trend is that most of the houses were purchased by the 31 to 55-year-olds. But this 22 to 30-year-olds is the future buying pool. They're the future buyers because they make the most money ever that any 22 to 30-year-olds ever made. And if you're 22 to 30 and you don't make a lot of money and you're going, really? It's not you, it's your peers, because your peers make a ton of money. We personally know a ton of people under 30 that make well over $100,000 a year. And when I was under 30, I was a pilot in the Marine Corps. I don't think I really knew, I maybe knew one person that was like the friend of my wife or something that knew someone rich that made that much. That you would be rich if you made that much money, like a lot of money. So that's a generation of people that have a pretty high potential to purchase in the future. So this chart was interesting. We thought we would put it in there. Any comments?
No, I mean, the bottom line is like you said, this is a generation that for the most part is rather affluent. Certainly compared to previous generations of that in that age group, and they will at some point pull up their big boy and big girl pants and say, you know what, I don't care what the world is doing, I'm ready to buy a house.
Yeah. I'm going to say this thing real quick before we do this. I get asked the question, when should I buy? Should I wait 6 months or buy now? If you're asking for like, when is the housing market going to bottom, it doesn't work that way. The housing market's not like the stock market where you buy a stock at a certain price. Every house is unique. So it depends on the neighborhood. It depends on the house. It depends on your timing of like, are you going to rent for another year? Because maybe you can't just rent for 6 months. Maybe it's the right time. So the right time to buy is when it's right for you. We've never said now's the time to buy or you should always buy. And we keep getting accused of that. And it doesn't benefit us to say that because we do listings like we just talked about. We represent sellers and we take listings. We put the houses on the market. If we wanted more business, we would just say the housing market's going to crash, give us your listing, right?
Right.
And we would get more listings. Okay. This is also from the Bankrate article. Okay, this was that 6-month number one I was talking about. Housing demand in our current cycle has been driven largely by demographics. We have the largest cohort in U.S. history of young adults between the ages of 25 and 34, prime age for household formation and home buying, and this group will continue to propel demand for the next 2 to 3 years. However, supply has failed to keep up with this demand, even in recent increases. So supply is up, but it's only at 3.5 months. And that's well below the 6-month supply considered normal.
Right.
So people are freaking out about there used to be a 1.5 month supply. Now there's more than twice that.
Right. And then please understand, this is nationally. So if you're looking at a particular market, your particular market might be 5 months supply, might be 7 months supply, might
Yep.
be 3 months supply. So they're just looking at it nationally. So here in Vegas, I think we're like about 5 months for supply of inventory.
Yeah, it's 4. I think it's 4.5.
Okay.
It's 4.5. But what's weird about Vegas is, remember, it was 30 days for condos, and it's still lower for. If you look at condos, it's still much lower.
Right.
But it's still well below 6 months. Is it going to increase? Maybe. This is the kind of year where we figure that out.
Right.
We still have more homes coming on the market than being sold, but it's not like it was. It's nothing like it was in 2006. Nothing. It's not even close.
No, and look, they're not being absorbed before they come on the market the way it was a year ago. And I just wanted to say something about your point as far as us always being bullish on the market and telling people to buy real estate. We don't. We simply say that, look, over time, real estate is a good place to park your money because everybody has to live somewhere. And over time, if you're going to be in the house 15 years, 20 years, that house will appreciate, okay? It's very likely that house will appreciate. And that's really what our point is as far as buying real estate. Real estate is not like day trading a stock. It is for a long period of time.
If you bought a house at the top of the housing market in 2006 at the very peak, even though that house got crushed probably 70%, 60, 70% in value, today, 16 years later, you're up 50%. Plus, you would have been collecting rent the whole time. So it would have been a fantastic investment. This is a quote from the article. Interestingly, the increased inventory levels is only partly due to a higher number of properties being listed for sale. A lot of it is because properties are taking longer to sell once they are listed. We all know this. Many buyers are holding off in hopes that prices or mortgage rates will drop further. So there's buyers who are sort of sitting on the sidelines waiting for time. They're trying to time this thing, which is interesting. I don't blame them, right?
Right. No, I don't blame them at all. The thing is, though, keep in mind that interest rates will be higher by the end of the year than they are today. So if you have a relatively short horizon for purchasing a home, you might consider that. Inflation is not abating, and that is the primary concern of the Fed, and they will continue to raise interest rates until they feel that they've knocked this out, and it's going to be painful. And this might be a longer run of raising interest rates than any of us have envisioned, because nothing in the last 2 years has been what we've envisioned.
Yeah.
And why should this be any different, right?
The other risk is, if you are buying a house, we recommend a relatively large down payment. If your plan is to buy the house and then refi it in a year, because if you have an equity loss in that year, you still have to have enough equity to refi. So you can't just buy a house at 100% and then hope. So what people did in 2004 was they would buy a house at a really high rate. They didn't care. In a year, they would refi it when they had some equity, and they would get a better rate because they didn't have a 100% loan. So, and they would knock a couple $100 off the payment. Today, to do that, you need to put money down. You need to have a substantial amount of money down to do that. These are some of the warning signs of a market crash that were in the article that we read. Everything's from the article. There's a link in the description if you want to read it, the whole article. Experts concur that we're not in a housing bubble currently, nor is a crash on the horizon. These are experts that said this. Still, it's good to know the red flags that signal potential market crash, including increasing loan-to-income levels.
So I want to cover that just for a moment.
Okay.
We are seeing new loan products out there because mortgage companies are getting a little bit desperate as far as trying to generate some business. So they are definitely looking at some more creative lending products out there with maybe different ratios. And so that is a concern going forward. But up to this point, the loans that have been done have been relatively solid with good credit and substantial down payments. So the loans that have been done up to this point have been really solid. The loans that are going forward, I think, bear some more scrutiny, and we'll see how those turn out.
I was involved in a chat with a lender who was mentioning that jumbo rates historically are higher than the normal rate. In a lot of areas are actually less. And they have like this special type of buyer who's like a preferred buyer that maybe they have a super high credit score, they have a really high net worth, but they're still borrowing money at a pretty reasonable rate to buy luxury, like a high-end home.
Right.
But they're putting a lot of money down. So it's like they're buying a $2 million house in some market, but they're putting $1 million down. So their jumbo $1 million loan is actually not at 6%.
Right. And it's interesting because we were chatting with somebody today who is in a luxury market, and he was just absolutely shocked by the fact that these 7- and 8-figure homes are selling like hotcakes in his market. And the discussion we were having is that a lot of these people are looking for a place to park money in an inflationary environment. So take that for what it's worth.
Yeah, in his market, what he literally said was low-end stuff and middle-range stuff is kind of stagnant, but the high-end stuff is flying. It's just selling like crazy still, which is interesting. Remember, like Wanda said, some of those people they're super rich.
Right.
And he's in an area that has athletes, actors, things like that. It's an affluent area.
Right. And, I had the same conversation with somebody over the summer who is in a resort area down in Mexico. And she was saying the same thing, that, stuff is flying off the market. And again, those are super expensive homes.
We're going to do another update in just a week for the monthly, and this will be the month over month. We're going to look at all the factors that are happening. This will be a Vegas update. The last update we did, we saw that the trend of homes coming out of the market was starting to decline. Like that was starting to tilt down. So it's still coming out of the market faster, but at a reduced rate. So at some point, we know likely in the next few months, potentially, it'll peak. We don't know if that'll be October, November, December. If inflation gets under control and the Fed starts dropping rates, we could see it substantially pick up again next year.
Right.
But like, when will the market bottom? Who cares? Because it's what neighborhood?
Right.
Because some neighborhoods, we've seen neighborhoods where there's no price reductions at all. Because there's 2 listings, and it's an affluent. It's an area where it's very desirable. So
and then there are neighborhoods where there are price reductions, and again, like we've said, it's because of all the unknown and the volatility and interest rates and all these things. And we do know that interest rates will continue to go up at least for the foreseeable future.
Yeah, I think so. Anyway, if you like the channel, please subscribe, hit the notification bell. Leave us your comments, and
we'll see you on the next video. Bye.
Bye.